Bitcoin. For some people, it's the absolute future of finance. For others, it's just a massive speculative craze. But underneath all those wild price swings, there's this fundamental puzzle. How do you actually value something like this? The stakes are unbelievably high. We've all heard the stories of early players seeing just enormous rewards. So today, we're going to unpack the psychology behind crypto valuation using insights from our sources.
So that brings us to the big one. The question that fuels endless debate, a ton of speculation, and let's be honest, probably a little bit of anxiety. What is a Bitcoin really worth? See, the answer isn't as simple as just checking a stock ticker, because with crypto, the very idea of worth is what's on trial.
And this is the heart of the crypto valuation puzzle. When you hear those stories about early investors turning these tiny bets into fortunes, it really makes you wonder, right? How did they see value where almost nobody else did? What were they actually betting on? Well, to figure that out, we've got to step back and look at how we value anything.
Okay, so here's the first major roadblock. You see, traditional investing is built on a pretty simple idea. An asset's value comes from the future money it can make for you. Profits, dividends, cash flow. But Bitcoin doesn't have earnings reports. It doesn't pay out dividends. It generates zero cash. So right out of the gate, the standard financial toolkit, it just kind of breaks down. This forces us to think in a completely different way. And our sources point to two sort of competing schools of thought on what really gives an asset its value. One is all about numbers and logic. The other is all about people.
This slide really lays out the two sides perfectly. On one hand, you've got the firm foundation theory, which argues for real, tangible, intrinsic value. And on the other hand, you have the castle in the air theory, which says, nope, value is purely psychological. It's not about what an asset is, it's about what everyone believes it's going to be worth tomorrow.
Let's dig into the firm foundation theory for a second. This is the bedrock of how most people think about investing. It's the idea that if you do enough analysis, you look at a company's health, its market, its future earnings, you can calculate a true value for its stock, and the price, sooner or later, should reflect that fundamental reality. And then you've got the castle in the air. This theory just tosses all the fundamentals right out the window. It says the game isn't about figuring out what something is truly worth. It's about predicting what the crowd is going to do next. The goal is to guess which castle is going to capture the public's imagination, and then you buy in before everyone else piles on. So where does Bitcoin fit in all this? Well, according to our sources, it lives almost exclusively inside the castle in the air. In this view, the whole crypto market is this grand, elaborate structure that's built on nothing more than collective belief. And that means the key isn't understanding balance sheets, it's understanding crowd psychology.
And believe it or not, this idea is anything but new. It's captured in a Latin maxim that's centuries old, res tantum valet quantum vendi potest, which means, quite simply, a thing is worth only what someone else will pay for it. This is the core principle for any market that's driven by psychology, from fine art to, as our sources suggest, cryptocurrency.
This all leads us to a more modern name for this strategy, the greater fool theory. The logic is actually pretty straightforward. You might genuinely believe an asset is overvalued, but you buy it anyway, because you're betting that you can find an even more enthusiastic buyer, a greater fool, to sell it to at an even higher price before the music stops.
There's this great anecdote from the source material that just captures this perfectly. A worker once brought a can that was filled with sand to a trader. When the trader asked what it was for, the worker just replied, "It's for trading, not for eating." It has no utility, no intrinsic value. Its only purpose is to be sold to someone else. And some analysts argue this is the perfect metaphor for Bitcoin.
Now, if all of this is starting to sound a little familiar, it absolutely should. This kind of speculative behavior isn't unique to crypto at all. It's a pattern that we see again and again throughout financial history. When that castle in the air theory takes over, what you often get is a speculative bubble. Our sources place the crypto craze in a very long line of similar events, from the so-called can't-lose stocks of the 70s to the dot-com bubble of the 2000s, and even the real estate mania back in 2007. The pattern is often exactly the same. There's a supposed new paradigm, a euphoric crowd, and a complete detachment from any kind of fundamental value. And history offers some pretty stark lessons about what happens next. The sources are crystal clear on this. Speculative manias are hazardous to your wealth. What happens is greed just runs amok, overpowering caution. And while a few people might get rich, these things historically end in financial ruin for the vast majority of people who get caught up in them. So, with all that history in mind, how does someone even navigate a market like this? Well, the sources suggest
It's less about financial analysis and much more about psychological discipline. Success, it seems, requires building a really strong defense against that magnetic pull of the crowd.
This slide really puts the two mindsets head to head. On one side, you have the psychology of the crowd during a mania. They're euphoric, totally overconfident, and utterly convinced that this time is different. And on the other side, you have the contrarian, someone who is cautious when others are greedy, who stays unemotional, and is mentally prepared to stand completely apart from the herd.
The economist John Kenneth Galbraith just captured this bubble mindset perfectly. He said that during a speculative boom, all past experience is just dismissed. A powerful belief takes hold that some new technology or new market has created a new set of rules, making all those old lessons totally obsolete. It's a classic and really dangerous psychological trap.
And this leaves us with the ultimate question. The sources we've looked at frame crypto less like a traditional asset and more like a phenomenon of mass psychology, a true castle in the air. In a market like that, the biggest challenge isn't reading the charts, it's reading the crowd, and, maybe most importantly, reading yourself. So the real puzzle is this: how do you separate a revolutionary wonder from collective madness?